Hello and welcome to Franklin Templeton and our very first Macro Moments webinar. Today we're going to be discussing emerging markets in a world on edge. This is the first of a monthly series of webinars that we're going to be running going forwards, and we're going to bring together experts and views and panelists to discuss the questions that are uppermost on your minds, our clients' minds. And we really want your input. So please send us your questions, get involved in the conversation, and later, if you would be so kind as to fill in our emerging market survey, give us your thoughts after the program as well. But let me start by introducing my panel today. Elias, welcome.
Thank you. Hi, Mike. Thank you. My name is Elias. I'm a client portfolio manager at Templeton. We are an equity investment team with a very long legacy in the EM space. We've been running EM equity strategies since the late 80s, and today we're running about $45 billion across EM equity strategies on behalf of our clients.
Marcus.
Marcus Weyerer. I run the global ETF investment strategy. So on the ETF side, we have about 70 billion assets under management, and the emerging markets are a big part of that, passive, single countries, and so on and so forth. So very glad to be here.
And lastly around the table, I have Oliver.
Hi, Mike. Yeah, Oliver Wallin. I'm part of the multi-asset investment team here at Franklin Templeton.
And online, I'm very pleased to have our regular contributor from the Gulf, Dino.
Hi, Michael. It's a pleasure to join you again. My name is Dino Kronfol. I'm the Chief Investment Officer for Global Sukuk and MENA Fixed Income. I'm essentially responsible for Franklin Templeton's fixed income business in the Middle East.
So we're going to look at emerging markets. We're going to be looking at a world on edge at this particular moment in time. I think we know what the principal crisis is that we have at this point. But let me just set the scene a little bit here in terms of how we're looking at it and how we're thinking about it. We are in a period of shock where markets are adjusting to shock, and that's not unusual. In fact, we've had 4 major shocks this decade. The number might be a little unusual, but undoubtedly the actual shocks aren't. We've had COVID, we've had the Ukrainian invasion, we've had tariffs, and now we have the Iran war. And we've produced what we call a chart of fears. So going back 125 years to show you all the events, not all the events, but most of the events that the markets have had to deal with over that very extensive period. And what you see is most of these shocks, most of these moments that happened, events we could call them, don't actually rattle the markets in the medium to long term. They come, they're important, but they move through. The events that do rattle the markets are actually the financial ones, the ones that we as a financial community are actually involved in. We can see coming. They are almost suspense events where you're seeing how it will develop and wondering how it will turn out. Perhaps the one difference was in the mid-70s, where you had an oil price shock that became, because of monetary mismanagement, actually a real event and a real financial event over the same period of time. So we know that these events can be short-lived. We know they're very powerful in markets. We know that markets can recover reasonably quickly. But are we in such an event of that nature today, or are we actually moving into something akin to the 1970s, where we will actually see a prolonged and greater shock? If we look at our pre-war GDP estimates, which is on my next chart, you can see that actually the world was doing quite nicely. India was leading the pack with growth between 6 and 7%. China a little bit behind, but certainly a solid 4 and a bit we were looking at. And then we have Brazil coming in and the US in that 2 to 3% zone. But that sense of growth being underpinned both by investments, AI, I know we're going to talk a lot about AI today, but AI and a development of a new type of consumer as a result of that was something that we could really see affecting markets, and a real positive, I think, for markets at that point in time. However, we have to bring in the question of inflation. We have to bring in the question of the impact of inflation on growth, and in particular, the impact on the consumer, I think, as inflation could well be a tax. But if we go forward a little bit and we look at one of the other drivers behind the growth that we have at this point in time, we can't help but notice the fact that there are major fiscal deficits still in existence. And on my fiscal deficit chart, which you can hopefully see, you can see that the leading countries with the leading growth rates got the leading fiscal deficits. there is an imbalance here that in the long term may well be that thing that moves us from an event to a shock. And it's something that we need to hold in the back of our minds. And in particular, those governments who are trying to finance a recovery through further fiscal deficits. Is that really possible? Is that really plausible? Last but not least, of course, we are in the most extraordinary industrial revolution, the AI boom, and the acceleration that has taken from the one big beautiful bill with 100% capex write-off. In our chart, you can see the enormous growth that has is impacting from the S&P, and you can also see that actually estimates for non-AI capex this year are probably too low, at around adding up an extra 4%. So whilst AI is taking all the attention, we think that the overall US will invest significantly more in a wider range of areas, and that will drive US growth again. And that's outside of any discussion about oil price shocks, etc. Because of course, as we know, whilst the price may change, there's no problem of supply in the United States at this point in time. So are we underestimating the power of the US economy? Are we underestimating its influence, and in particular back onto the emerging markets? Let me stop there and let me move to Dino. Now, Dino, 11 weeks ago, we had you beamed in on stage in London, talking about the conflict and the start of the conflict, talking about the fears that if this conflict ran on, that it would have a significant effect. Here we are, 11 weeks on. Nothing really has passed through the Straits of Hormuz. Nothing really has changed in terms of the position of energy supply, and markets are pretty relaxed. What's your thoughts?
Well, I mean, I feel like it's, somewhat surprised would be fair. I mean, I feel like the market has been consistently optimistic about, this conflict or the kinetic action, subsiding. And to a large extent, I think the market has been correct. We have a ceasefire in place. I think the parties are, still negotiating, and in that sense, I think the market's got that right. And fears of a, more significant escalation haven't materialized. And I think if we look at the pricing in the market today, it would suggest that that's, the probability of that continues to decline. But what the market has also been very wrong about is the fact that these straits will reopen fairly quickly. And as you mentioned, we're 11 weeks into this and the straits are still closed. And if we think about the other objectives of this conflict, which is, the regime, nuclear weapons, etc., I mean, all of those remain outstanding issues. So to a large extent, this war seems to have been ill-conceived, and I think we continue to have, more questions and answers at this point. But at least we do have a ceasefire, and the market is certainly pricing in a more positive outlook.
Dino, if we are in 11 weeks' time in the same position that we are at this moment in time, what impact do you think that will have on the markets, or will we remain sanguine?
No, I mean, I think, the pressure will continue to accumulate, right? I mean, I think at the end of the day, you will see, the shortages or the impact of the straits, I think, continue to compound. I think we will see higher oil prices, higher fertilizer prices, higher food prices, and all of that should transmit into inflation expectations and therefore into a rate market. I mean, already as it is, if you look at it, you see, we've shifted quite a bit from the beginning of the conflict till today. I mean, in the UK and Europe, I think we're looking at 3 hikes being priced in at the moment. The US went from pricing in 2 cuts to maybe half or 1 hike by, a year from now. Japan, anywhere around 1.5 thereabouts in terms of hikes. So clearly the momentum has shifted, and we've now priced in, I think, a slight inflationary impulse. But I feel like if this is another 10 weeks, I think that slight inflationary impulse becomes something much more pronounced. And I think it will obviously have an impact on growth as well. So there could still be, significant economic and inflationary consequences to what we're witnessing.
But for now, that slight bifurcation between bond markets you feel is reasonable?
For now, I think so. I mean, I would still argue that the markets continue to, err on the side of optimism. I have to give the market credit for calling the kinetic de-escalation. But I continue to be worried about developments, and the fact that these straits remain closed, and these negotiations are not going quite well. It leaves me a little bit worried.
So how long do you think it will be until the central banks push the panic button? You've mentioned that you're expecting 2 to 3 rate rises across Europe. When does that start?
Well, I mean, I feel like you already have a divergence in opinion. I mean, you already have a lot of allies in the Middle East already extending, and talking to the Iranians. You have the Americans today in China, and essentially trying to get the Chinese on board to try to find a resolution. Europe, obviously, is feeling the impact of this conflict more than the U.S. and is trying to push, and was certainly trying to pull back the U.S. from further military escalation. So, I think the combination of all of these different participants or parties trying to de-escalate and reopen the straits, hopefully, leads to, is successful. But, the two parties that started this conflict, namely Israel and the U.S., I think we have to wait to see how, they react to the lack of consensus or the lack of popularity of this ill-conceived conflict.
So is from where you're sitting, is life returning to normal at the moment? Do you see business life beginning to start back up again, or are you still seeing dislocations?
Like there are a lot of, travel is back, people are back in the office, you do see traffic on the roads, etc. But, the hotels, were empty, restaurants have been hurt. We're starting to see when we saw the quarterly numbers, we're beginning to see pickups in NPLs at banks and some pain, coming through. We obviously see a significant decline in real estate transactions. But this data is still, early. We only have a month, in that first quarter, which had started out quite strongly. So I feel like we'll start seeing the impacts of this conflict, come up in numbers over the next few months. But, if we reopen the straits over the next couple of weeks or next couple of months, I think all of that will ultimately be manageable. The worry really is about if these straits remain closed for an extended period of time, and by that I mean 3, 4, 5 months. I think that type of a time frame will push that inflationary impulse much more significantly.
Dino, thanks very much for that. Oliver, let me turn to you now. So a rather more benign situation, actually, with an exit route, a clear path out of it at this moment in time. Extreme events, high risk outcomes. Is this all discounted in the market at this moment in time? What's your view as an asset allocator?
Yeah, so as an asset allocator, as an investor, we are showing the more optimistic view on equities. And we're looking at events and we expect the markets to be able to look through any short-term setbacks that we see or experience on the path to resolution in the Iranian conflict. And what sits behind that kind of positive, optimistic view is strong corporate earnings. And that is the underpin that allows us to be more optimistic on equities, although it's easier to be optimistic and bullish on equities than maybe bonds. And as a stance, we are more risk on as a consequence. And I've got a table or a chart up here that shows our pendulums and our sort of preferences for markets. And emerging markets ex-China, that is our sort of strongest macro region at the moment. And we have been kind of overweight that region throughout this year, but we are backing that with more conviction. We have there a more neutral view on China. And with emerging market debt, we are sort of also neutral. We see very good long-term attractive components within emerging market debt, but in the near term, it is emerging market equities that offer a more attractive upside potential for us.
So if you're not overweight China, and looking at the pendulums, you're not overweight China, what are you looking to be overweight in the emerging market space?
So we are, it's basically emerging markets ex-China. So we are looking at, and we're supporting that particular reason for 3 core regions. The first is the earnings story. So if you look at the chart that I have here, the EPS story is a core reason why you like that region, full stop. Double-digit growth in sort of expected forward-looking earnings and in trailing earnings too. So the earnings story is very strong, and that is driven primarily by the AI theme that you've mentioned and that we can't avoid. The AI theme is still ongoing. We can see some big capex spend in the US, and that is projected to be even further amongst the hyperscalers that you've alluded to. And so the big area of spend, that the beneficiaries of this are semiconductor manufacturers, hardware, tech hardware, memory, chips, and this all falls into the favor of the kind of Korea and Taiwan regions, which are dominant countries within the emerging markets. And we're also a little bit more positive or softer on the sort of risk about energy, the energy risk. There is these markets are traditionally vulnerable to energy prices. There is always concern about supply shock or price shock, but what we think markets may not be so attuned to is the reserves that a lot of these countries have. And a country like Korea apparently has about 200 days worth of oil reserves. So that protects it a little bit from the supply shock potential. India, I think, has about 70, 75 days, less reserves there, but still maybe a little bit more sheltered. And so this kind of idea of oil price supply shock equals sell Asia may be too simplistic a view. And so we're a little bit more positive around that.
So within the markets themselves, they've built up some pretty decent defences on that basis. So you're not worried about an inflationary blip?
Less worried, and less worried that the markets might assume, broader markets. We're more optimistic about that, and we do think the tailwind of AI and the good health of corporates within the emerging market space makes it our most attractive region in the near term.
And tariffs are a thing of the past.
Well, tariffs are still there, but it's the demand. I mean, the demand cycle for this tech hardware is the real driver for the region for us. And that is what supports our look-through and supports the case for corporate earnings.
And does that go all the way into the sort of rare earths, the minerals and materials side of things as well?
I think that has feed through, absolutely, yeah. But it's the demand for the tech hardware. And when we look at the best sort of performing sectors in the past few months, it's all been around that. It's all in tech hardware, one form or another.
So, Elias, we have to come to you here because now we're going to have that debate between the two AIs, aren't we? So where do you stand on the AI of shock or the AI of positivity that Oliver's just been talking about?
No, absolutely. I mean, if you look at equity markets, the market's been really focused on the one AI, which is artificial intelligence. And as mentioned here, ignoring the other AI, which is America, Iran. So, if I look at the MSCI Emerging Markets Index, it's up 22% year to date, outperforming all other regions. Even if you look at since the end of Feb until today, the market's up 6%. So that's since the war started. Yes, we've had that sell-off in March, but then we've seen a very strong rebound afterwards.
I mean, it's a very temporary sell-off, wasn't it?
Exactly. So the market was down about 13% in March, but then rebounded 15% in April and continued. So overall, the war, we're still up. So why is the reason up? I think the focus is on AI. There is substance behind that trade. So as we mentioned, we are seeing a technology super cycle going on, driven by this AI. And the AI is with the hyperscaler spending 700, 800 billion in capex. When we look at the AI rollout and the picks and shovel for that AI infrastructure to be able to deploy it, key players among that value chain are EM players. And so they're seeing a very strong earnings tailwind from that investment. Now, the question last year was about monetization. Yes, there's a lot of capex, and we recognize that. Are we able to monetize that? Data is suggesting that, yes, there is some very strong monetization potential. If you look at Anthropic, at the end of 2025, they've reported 9 billion in ARR, annual recurring revenue. At the end of April this year, they've reported $30 billion of ARR, annual recurring revenue. So there's definitely a monetization potential. We are still in the early stage of this AI deployment, and that's why the market is very, positive on the potential for it. And the earnings growth prospects that we see are very strong. EM equities are expected to grow earnings over the next 3 years by an average per year of 28% annually. That's larger than what the S&P 500 is expected to grow in the next 3 years by about 16%. If you look at the developed market index, they're expected to grow earning by about 14% CAGR over the next 3 years. So certainly agree with what Oliver mentioned, that earnings growth story is driving the market.
let me bring you back to reality again, because we have had a significant rise in the cost of energy. We've talked with Oliver. You mentioned that there's a bit of a buffer there. There are some ways of mitigating the impact. But surely, I mean, we hear the stories out of India of the loss of cooking oil. Surely this is having a real impact on the ground of those countries that are energy importers.
It is. I mean, I would say when you look at the EM universe, the picture is nuanced. Obviously, when you look at the Asia region, Asia is a net importer of energy. So any volatility in oil markets and oil prices will have an impact. But for example, there's a nuance between China and India, say. China has a lot of mitigating factors in play. If you look at the energy mix of China, 20% of it is reliant on oil. There's 30% of the energy mix reliant on renewable energy, and that's expected to be half of the mix by the end of the decade. So definitely the reliance on oil of China today is very different than what it was 20 years ago. The other reason is we talked about strategic reserves. China has the second biggest strategic reserves in the world in terms of oil, but also China has the link to Russia. So the availability or the supply of oil, even if the Strait of Hormuz remains more or less, which is not helpful at all, but there's that link with Russia where they can get supply availability. And yes, they probably will pay higher prices, but with the Chinese situation, they will not pass it on directly to consumer. The government takes a bulk of that higher price pressure to support their consumer. So I think that's why the market recognizes some mitigating factors. On the other hand, India is in a less sweet position, I would say. India obviously is a net importer and relies heavily on oil from the Gulf region, and so the Strait of Hormuz closure is very painful for them. So the picture is nuanced, and the equity market performance is reflecting that. When you look at India year to date, is lagging the rest of the pack.
But when we look at that, the downgrades of earnings are there. We've got that GDP cut that was just seen from a number of the major banks, little tweak up in the inflation, but the number of movements pretty small, 6.75% to 6.2%. Is that really worth worrying about?
Absolutely. I mean, India has to see the short term and the long term. In the short term, they are going through the perfect storm, I would say. You have the energy crisis. Being an importer doesn't help. They have a very large IT sector in their market, which is the software IT services sector is seen as disrupted by AI. And so we've seen the Indian market bearing the brunt of these kind of worries. But I think over the long term, the structural India story remains very valid. As you said, India is one of the fastest GDP growing countries in the world, and that higher GDP is translating into higher earnings. You're having India reaching a cusp in terms of consumption. When you reach the 4 to 5K per capita income, typically that leads to an inflection point in consumption where goods and services, the penetration you see in India today is very low compared to other markets. Once you cross that 4 or 5K per capita income, you're seeing a pickup in consumption there, which should benefit India. Let's not forget that there's a very strong private sector in India with very strong balance sheets. So long term, there's a lot of the good ingredients for India to be a very attractive market in the long term. But yes, there's no deny that there's going through the perfect storm today in the environment that we're going through.
The short-term pain, but the long-term story is still intact. Marcus, I'm sorry, we've got to come back to AI. We've got to come back to South Korea and Taiwan. So let's dive into that. Let's talk about what is the actual impact that is having on both the companies and the wider economies.
Yeah, so I think two things, right? Number one is, as we already discussed, it's a long-term story. So that is very obvious now. If we look at Korea, for example, Korea has two companies, Samsung and SK Hynix. There's a third one, Micron. Those are three companies that produce HBM chips that can be used for AI applications, and that's it. There's pretty much no one else out there. To the extent that actually those chips have been sold out, so the capacity for production has been pretty much sold out through all of 2026, going into 2027. Now, there's a little bit of new capacity coming online in 2027 from Micron and Samsung with new production facilities. But by 2027, and we've seen that in the latest earnings season in the US, CapEx guidance has now gone up from about 600 billion to about 700. So part of that is because higher prices, but part of that is because they actually need more. So from an investor's perspective, if you believe that for the next 1 or 2 years there is no technological advancement and that AI trade is strong, then those countries, particularly Korea, but also Taiwan to a slightly different extent in the supply chain, but still affected, they are going to do well. And also particularly because those companies that I mentioned, or TSMC in Taiwan, they make up a really large share of the index, of the country index. And Elias just pointed out the numbers for the emerging market, right? That for emerging markets broad, those countries now, because they have rallied very strong, make also a large share of the emerging markets index. So a lot hinges on the AI story. But if the view is that that trade has room to run, then emerging markets have room to run, and Korea in particular. But I want to make one point here, because if we drill down, everyone talks about AI, right? And it's a great story, but there is more to emerging markets than just that. That is also important to bear in mind. India, for example, they have the demographics. Korea, there's a huge defense opportunity there. It's already the second largest exporter of arms into the EU. We all know, I don't want to put a hard number to it, but to reach the 3.5% of GDP, we need to spend about 700 billion over the next 10 years. So there's a lot of other stories that are just not as much talked about because AI. But there are other stories. And Korea, I may add, for example, also a big driver that we see over the next few years, and that almost nobody, I wouldn't say nobody, but very few clients actually, when we speak to, see that as a major driver yet, is the corporate governance reforms that are going on there, really also on the government agenda high up. So I think a lot of reasons to be still positive for emerging markets, and then being a bit mindful of starting to look at them not as a big aggregate, but starting to look a little bit more nuanced, especially of the background that we have with the geopolitical crisis going on.
Let me just take you back, because obviously we have this extraordinary boom going on and acceleration in demand for every component in the whole series of data storage, memory, and indeed the development of large language models going back to Taiwan. We see on our estimates an aggressive growth in capital expenditure, and that capital expenditure then topping out, but holding those levels at the sort of $600-800 billion levels a year. Is there a risk that the companies overbuild capacity? Is there a risk, because we've seen huge cycles in memory and DRAMs in the past, is there a risk that we go back to those cycles in 2 or 3 years' time?
I would actually say it's almost a guarantee that they will overbuild at some point, with a nuance, because you pointed to the flattening out of capex at some point. I think for now and for a few years probably, we're still really very much in the build out phase, especially as the new models come. They require not incrementally but almost exponentially more, especially memory currently, for the inference to make them smarter and quicker, especially to handle more data. When we reach that point, a few years from now, and there will be then more capacity, then it will start to become more cyclical again. I mean, the boom and bust of the semiconductor industry is infamous for good reason. We do think so that it will be, the volatility may be smoothed a little bit, because there's this big, think about 5 years ago, we didn't have all of that demand that is there now. That is that completely new demand, right? So there will be some cyclicality, but it will be probably on a slightly higher level in terms of the absolute demand, and the swings may be a little bit narrower because of the structural demand that is going forward. And also once you've done the build out, that doesn't mean that you're done, because everyone needs to have the newest chips every time, because if you don't have them, then your model is going to lag, and your capabilities are going to lag.
Yeah, that replacement demand is clearly going to be very aggressive on a 3 or 5 year cycle, isn't it? There can be no doubt about it. I'm just going to turn the question slightly. Does this boom benefit the ordinary man on the street in South Korea? Are we seeing that spread across, or is this just confined to the specialist companies?
So I think there's a lot of people obviously working for those companies. Those are companies employing many hundreds of thousands of people. They are earning quite well as well. So that is positive on the one side. On the other hand, you have all the suppliers, the service companies that work with them. So that also helps. From an investor's perspective, it is concentrated in really those few names. But that's Korea. For example, Taiwan is another story. Taiwan has only pretty much one. I mean, there's another one, MediaTek, but TSMC makes up the bulk of the index. But there are, and I don't know the exact numbers, right? But there are estimates that every second person in Taiwan has some direct or indirect link with TSMC. So that's how dominant those companies is.
Yeah.
And even though it may not be immediately filtering through, but through better salaries and bonuses and shareholder programs, so that there will be some filtering through to the economy. It will also help generally with relaxed, more relaxed financial conditions generally, because those companies also pay into the, they pay taxes essentially. So there's a lot to it. But it's not. It is a bit of a narrow story, so there's no denying that either.
Yes. Okay.
Yeah.
Now we have a very rich tapestry, a very rich opportunity set in the emerging markets, and actually a lot of the countries are really very different. We've focused on the AI piece at all. We haven't touched on Latin America, and we haven't. Give me a sense of what is going on in Latin America at this moment in time, and whether or not you see some positives there as well.
Yeah, so we like Latin America, but as a diversifier. So the growth clearly is in Asia predominantly. So, I mean, Korea and Taiwan, especially on the AI trade, then India, more those very long-term structural story. We fully agree on that as well. I think currently Latin America is viewed also by investors. That's how we see it in the flows directly. Viewed as a diversifier. Brazil, if you take it for example, right, they have pretty much zero exposure on the tech cycle. It's a very heavy economy on domestic consumption, even though you don't see that in the index much, but it still lends to a little bit of geopolitical stability. And then of course you've got them as an oil exporter, food exporter.
Yeah.
A big structural potential driver, strategically important, could be the rare earth reserves that they have. They have about between 20 to 25% of global reserves, but only 1% of production capacity. That's almost exclusively in China. Now we have Trump in China currently, but if you believe that this disentanglement between the US and China continues over the long run, that then the US will eventually want to have more security in terms of rare earth, probably closer to home. We think Brazil could be a great spot, but it's a very long-term story, not for the next 1 or 2 years, but more for the next 5 or 10 years.
Elias.
Yeah, no, I mean, I would say as active stock pickers, we're finding very attractive opportunities in the Brazilian market. If you look at Brazil, it's trading at about 8-9 times forward PE, while the broader market's trading at 13 times. So attractive valuations, while at the same time you have very interesting companies with very interesting shareholder return profiles, whether it's through dividend, through buybacks, with very cash generative businesses. The quality of management teams we find there are world class. These are people who are able to manage and grow their companies in very difficult conditions, like the hyperinflation that they suffered from for years, political uncertainty, and they still manage to operate and grow their businesses. So we think there's very attractive opportunities to be had there. Also, when you look at the market, there's earnings growth, about, if you look at the next 3 years, I would say there's an average of 19% growth EPS per year for the Brazilian market. We look at, so we find it very attractive. We're actually overweight Brazil in our
that's really interesting.
EM strategies. And whether it's on the commodity plays, being a beneficiary of what's happening today with the higher oil prices, while at the same time being a bit far away from the actual conflict helps. Whether it's on the mining side, where there's, as mentioned, there's some key elements that are absolutely, needed to transition towards that more digital world or more the electrification trend, whether it's through copper or through other types of minerals or commodities. And then also there's other opportunities locally with the healthcare sector or some financials that are world-class companies based in Brazil. So very attractive area, I think. And a lot of the people sometimes maybe, dismiss it. They look at the political landscape, and obviously we have elections coming up in Brazil in Q4. Maybe that's a source of some volatility for some investors, but actually looking through that and looking at the long-term prospects of the country, it looks attractive from an equity perspective.
And as an asset allocator, would you agree with that, Oliver?
I do. I
It's
think
more
that-
than just a risk diversifier.
Yes, I mean, it's interesting because, I mean, emerging markets in our broad portfolios are only a relatively small allocation, sort of 8-10%. And you do have to consider the diverse nature of this market, all the things we've talked about, all the different drivers, all the different countries. And it's hard to justify how much time you need to spend to capitalize, get the most out of this region. So we tend to outsource ourselves to the broad sort of categories, global emerging market funds. And what Elias is saying is it should be an attractive and inviting space for active managers, because you can, if you are exploiting this bottom up, on the ground insights that you're getting across the world, that should feed through to returns. So, active management in emerging markets is a pretty attractive.
And they finally got their inflation problem in
Yes,
hand,
exactly.
and so the central bank started cutting interest rates, which should hopefully be supportive for equity valuations.
And that goes for Argentina as well. We've seen a significant transformation of that.
Which is, to that point, on the active management side, so that when we talk about, ETFs are not passive, but often viewed as a passive vehicle. So when you're obviously investing in the index, you're beholden to whatever that is. And from that perspective, Brazil is seen as a diversifier because you have the oil companies and that. So you don't have the ability, obviously, to pick stocks in, for example, consumer. If you want to be overweight there, you just don't have that. So that's why the view, I think, from a passive lens and an allocation perspective from Brazil is a bit more nuanced and less bullish than, for example, Korea.
At this moment in
So,
time,
Michael,
different attractions. Dino, yes, come in on that.
No, I mean, I think I concur with a lot of the optimism around emerging markets, particularly the fact that there's more to the story really than just AI or kind of geopolitics. But I think there was a lot of enthusiasm around the earnings potential and how long and how deep this AI story can drive these earnings going forward. And I just wanted to remind everyone, and even at the risk of sounding like the fixed income manager that's more negative than equity managers, but I think it's important just to remember that you have to tie the AI story to energy. All of this, all of that investment, all of that capex, all that compute power, ultimately all relies on the ability to sort of, diversify energy mixes and you basically increase the energy production that you have in all of these different markets. And so really the challenge that we're having with the straits and the shortages in the oil markets and the oil and the volatility there is definitely not helpful. And I would also add that, the other thing you want to link to this AI story, I think, is also around policy implementation. And, and here I'm really referring to a couple of things, but I think you highlighted it a little bit with your fiscal deficit chart. So there's no doubt that, because you have such high levels of debt in many of the developed markets, you already see that manifesting itself in real policy constraints. And so being able to manage these economies and really being able to sort of put together, sensible policies to promote, whether it's the AI implementation or energy or manufacturing or better trade deals or, supply lines and so on. I think that's an open question. Like, we haven't been doing a very good job at managing, the politics, and these are going to remain outstanding. And so I just think that, we want to be cautious, and really think about this. Like, you cannot have one area, sort of booming, while you have these other sort of serious challenges that actually that boom is dependent on. And you can't help but notice the concentrations, right? The concentrations of capex, the concentrations of earnings. You mentioned these companies that are beneficiaries, and so really being, finding a sensible way to distribute those gains and those profits, I think is going to be important over the next few years. And I just think investors want to kind of keep that in the back of their minds as well.
So if I can jump just in, the point that Dino just made. Korea, obviously been outperforming massively, right? But a few days ago, there was the finance minister who actually said some of the he called it excess gains of those semiconductor manufacturing companies in the country should give something back to the people. And I mean, the market dropped 10% on that day, just on that news. It's recovered very quickly, but it just shows, I mean, it supports the point, and I would fully grant that point, actually, that there are those risks. It doesn't look like there will be a special tax in Korea, but even just the fact that people start talking about it, you can't have corporate profits booming for indefinitely, whereas workers are not participating, because it will lead to populism and eventually a harsher environment for corporates than a better one. So
this is the debate around the K-shaped economy, isn't it? Yeah. The K-shaped drive that we've got, Dino, and I think you brought that out really well. Oliver, did you want to?
I was going to say, because I think there are some things that get slightly lost when you're looking at emerging markets that we probably haven't really touched upon, although Dino lightly did there, is that it's not just about the AI story. Emerging markets have been improving over the past decade. They're much more attractive for sort of outside investors like ourselves. And when we're looking at things like improved macro environments, with more flexible monetary policy and fiscal policy, sort of more developed, and there's a lot of work gone on at corporate level that makes it more attractive. So, better corporate behaviours, better corporate governance, that's going to attract more money in as well. And I think those things, we are touching upon here. That's another theme that's coming through on emerging markets. These places are becoming a more attractive investment opportunity because of these maybe less sexy factors rather than just AI.
Yeah, but they're quality factors. They are really important for resilience and long-term resilience and long-term corporate profitability, and obviously attracting longer-term capital. Now, we've only got a few minutes left. So I'm going to take a couple of questions, if I may. Okay. Dino, I'm going to start. This first question is about the thing that's heading the newspapers at the moment, which is the China summit that we have between Trump and Xi. Do you expect anything to come from that? And if so, what?
Oh, that's not an easy question to answer. I think that the Chinese are trying to, de-escalate tensions. This rivalry between the U.S. and China, is not something that everyone sort of, agrees with. And so I think if we can have, better relations between these two superpowers and, try to use that to sort of de-escalate, tensions around tariffs, maybe keeping the Straits of Hormuz open or reopening them, or at least making sure that it's not militarized. Again, obviously, not having this AI war be so contentious. I think all of those, would be beneficial, would feed into the positive atmosphere you have, building in the market. So that would be what I would be hoping for. Whether or not that's achieved, I think we'll have to see. But certainly the rhetoric coming out of the US around the rivalry with China is not something that has been very helpful.
But it seems an improved tone at this moment in time from just having that meeting. And when you get an improved tone with Trump, do you not always get a better trade deal somewhere?
Yeah, I mean, it is a positive that they're meeting face to face and that, it's taking place. Yes, there's a lot of headlines coming out of it. What I would say, it's interesting to see who went with Trump on that trip. If you look at the CEOs that went with him, you have, so Meta is there, Micron is there, which is what mentions the key, memory player, which is a US company, other than the two Koreans. And the Chinese are, whereas Google was not there, the CEO of Google is not there. And we know Google, how close it is to the kind of defense complex within the US. And Google pulled out of the Chinese market a few years back, and because of censorship issues, and they're not trying to come back. So it's interesting to see that who went with Trump is where China maybe misses some of the leading edge technology on the memory side or on the NVIDIA side. So Jensen, also the CEO of NVIDIA, is there. Whereas where they have local players that can do the job perfectly well and maybe very high content, like the Tencents, Alibabas, that, are facing, if you like, the Googles of that world, they were not there. So China is trying to take what it can benefit from, and the US is trying to play its bargaining chip. And this is normal. Hopefully we get, we're in the truth that was signed last year. We got a 12-month truth. Whether we continue to that truth or we sign something more permanent, whether we see any development on the trade trades it, a more permanent solution to the trading between China and US, that will be very constructive for the global economy and for everyone involved. So let's see how that comes out.
So watch this space, but it
watch this
feels
space.
like a rapprochement is happening here at this moment in time.
And as you said, I mean, they don't tend to have big events like this unless there's an expectation for something positive to come out of it. And so, in a permeable stance, I'd be optimistic of that outcome on that.
So
basis.
we're running into. So lots of questions have come in. I'm not going to be able to take them all here. We will, I promise you, answer those questions outside of this particular forum. So please keep sending them in. I've got a really nice, easy, quick one. Which frontier market do you expect to come into the EM market space and why? Marcus.
So the next one that is actually pretty much confirmed on the FTSE side. So we have two major index providers, really, MSCI and FTSE. On FTSE, it's going to be Vietnam. I think that there's investors tend to get, especially ETF investors tend to get very excited. We can do an ETF on that and we can invest in it. So well, on the one hand you can, on the other hand, you always have to be a bit careful. So there's a economic argument why we may find Vietnam exciting. The question is then what, especially on the passive side, what are you getting when you buy the index, right?
Yeah.
But so I mean there's lots happening all the time. I mean there's like on the corporate governance side, a lot of countries are making real progress as well. They are growing. So the next one that is happening is Vietnam, but there may be others in the queue at some point.
It's a dynamic space.
Very dynamic space.
And again, many of the things we talked about here are really helping. I'm going to have to stop us there. I know we could go on further. Dino, Oliver, Marcus, Elias, thank you so much for your time today. That is the end of our first Macro Moments webinar, the first, I hope, of many. We will see you in a month's time where we will look at the change in estimates for 26 and 27 and start to think a little bit further forward and review the year. Please send us your questions. Please fill in the emerging markets survey form as well. Give us your feedback at this point in time. And thank you very, very much for everybody who's listening, everybody who's participated, and in particular for my collaborators today. Thank you very much indeed.
Thank you, Michael.
Thank you, Dino.